Joining us, everyone. Welcome to this latest presentation of the New Mexico Small Business Development Center, or SBDC. Today, we're going to be talking about business succession plans. This is part two of a two-part seminar that we've been offering this week. Presenting today, we've got myself. My name is Ian Alden. I'm a business and tax attorney here in Albuquerque, New Mexico, specializing in business startups, and business successions, mergers, acquisitions, basically business needs in every part of the life cycle. We also have Nick Baker here with us today, who's going to be the primary presenter. He's a financial advisor here in Albuquerque with a specialty in business successions and business planning. So, Nick, if you want to hit the next slide real quick.
Absolutely.
The next one.
Beautiful. That's us.
So a few bits of guidance before we get started. Be sure to mute your audio. Let's just say audio. Go ahead and mute it. It should be muted anyway because of the way this is styled as a presentation, but just in case, make sure it's muted. Make sure you set your Zoom ratio to fit window. That way you see everything on the slides and you see all the video presentation. We will be using the Q&A function to take questions. We may answer some questions during the presentation, or if nothing else, we'll answer any unanswered questions at the very end. So at the bottom, there's a Q&A feature. If you hit the button, it'll let you ask a question and it'll go to all of us as presenters. Also, something new this week, we have closed captioning available. At the bottom of the screen, there's a button that says CC. Go ahead and click on that to enable or disable the closed captions. It may be automatically enabled for some of you. So if you don't want to see it, you can click on that to disable. And if you do want to see them, click on that button to enable them. Go ahead and go to the next slide. So today's presentation is going to address business successions, funding for buy-sell agreements. Really is a continuation of the last seminar. There's going to be a bit of overlap, but a lot of new information. And with that, I'm going to go ahead and hand this off to Nick.
Yeah, thank you so much, Ian. And this really is trying to bookend together with Ian's presentation from last week. It was excellent information. I completely nerd out on all this stuff, so I got a lot out of it. Today, and of course, thank you to the SBDC, huge resource for the community. Obviously, if you're here on the presentation, you know about it. But in here, they've got just a lot of good resources. So just always as a plug to make sure to go use them as a resource for training such as this. So today we're going over kind of three different sections. First one is diving in business succession. Again, this is probably the most overlap with Ian's presentation and my own, but it's also kind of a slightly different facet. Typically there'll be three key components. There are three key people in a lot of a business succession, besides the owners, of course. There would be the tax professional, the legal professional, and often the financial or insurance professional in there as well. We're the trifectum, so to speak. So some of it's a little bit from my facet of it to really kind of fill out more of that three-dimensional view. And really we'll dive into, hey, you've got a business, you got to think of the exit. What's the end game for this thing, and how are we going to get out of it, and when, really. And that can guide a lot of where your business, how it can grow, and some of the decisions that you do make even early on in running a business. Now, a buy-sell is one of the critical elements of this. So we're going to talk a little more in depth in this section about a buy-sell agreement and the roles it can play. And of course, go over the 5 different ways you can exit a business. Now, in the second section, we're really doing that deep dive into the buy-sell agreement, especially the funding or financing side, right? Because someone or some entity is making an agreement to buy out a portion of your business at the event of your death or your partner's death or so on. You want to know where that money is going to come from, right? And so we'll go over all the different options and what might make more sense for your business or for your client's business or whomever we're dealing with there. And finally, we're going to dive into life insurance, which can often play a large role in succession as well as protection for a business, and a few other facets. And I decided to flush this area out a little bit more because I know Ian touched on it a couple of times in there. Mentioned like key person insurance, so we'll really get into that, and we'll go from there. Okay. Now, anytime, of course, if you have a question, load it up in the Q&A. I'm here. Quick caveat, of course, I'm the financial professional. If there's anything that refers to taxes in any way, just please understand I'm not a CPA. So that is just generally known knowledge. Okay. Uh, the legal side, if I'm mentioning it, that's really generally known things, and Ian is the expert there that can answer more in-depth questions on legal.
I am also a tax attorney, so if any of those questions segue into the tax realm, there's a good chance that I can answer them on this call, or otherwise, if not, I can at least point you in the right direction, whether that's your CPA or some of the SBDC resources.
Perfect. Yeah, and that's a great resource. By the way, as a financial professional dealing with business successions, if I can find an attorney that also does tax work, that is always a huge bonus. Not a lot of attorneys like numbers. So, so when we get into this first section, which is the business succession, there's always one thing you really got to know and internalize about your own business, and in fact, kind of everything in your life. And that is that every single bit of property that you own, everything you're building today, everything that you have built, and everything you will build in your lifetime will eventually be owned by somebody else. Sometimes this can be a jarring thing to really think about and realize, this is going to go to someone else someday. And in fact, every single dime you own, unless you're going to be buried with it, which is probably less common now than I imagine it used to be. I don't know if people used to get buried with their wealth, but everything that you're creating today will go to somebody else. So we can't change that. However, what we can change is we can say, let's implement a plan to say, hey, when eventually I pass, I want my property or my business or whatever you've created to go to the people that you choose, perhaps at the time you choose or in the manner you choose, so that hopefully it can still accomplish the goals you originally set out to accomplish, And in regards to a business, this can be really complicated and messy if it's not set up right, right? There are countless stories of business owners who suddenly pass, right? We think we'll live forever and then we don't. And it leaves a mess for family or for business partners or for your clients and consumers or employees, all these people that your business actually supports. And so the plan is critical from that point of view. And the plan is also important to saying you have a goal to go for, right? Some of it's that legacy piece, saying I've created a business and I want to leave a legacy to live on forever. Some of it might be, hey, I just want to make sure that I can retire at a certain point, and I've got to have that end game in mind. I want to sell the business while I'm alive, for instance. Well, you got to plan ahead of time rather than trying to figure out a year or two beforehand, running to a financial professional going, how can I retire? Everything's in my business. What do I do? So we're going to start by talking about the ways you can actually exit a business, right? And this fun little grid here really dives into, there's two ways you can exit the business, and that's through a sale or a gift. And there's two time frames, right? While you're alive or at the time of your death. So we're going to touch on each of these boxes and a couple of things to consider for each. And at any point too, Ian, chip in with any additional, because you got a ton of experience and resources here in this area too. So if I miss anything or anything then from your facet they pop up on, please chip in. So that first box, this purple box here, a gift while you're living, probably see this often in multi-generational family businesses where, hey, you've created the business and you want to pass it on to your son or your daughter, say, hey, now it's your turn to take over the reins and take on the family business. Occasionally, it can also be a gift to, let's say, a key employee or, someone that they might be your family. I recently dealt with one of these that originally the owner didn't have kids. And so the employees who'd been with her for 18 years, early on, their expectation was that it would be a gift. And then that changed that changed as retirement got closer for the owner. So, but there's nothing wrong at all with gifting a business or a portion of a business to somebody else as part of your exit. But there's a few things to consider. One thing being the tax consequences, of course, to yourself as well as to the person inheriting it. Second is you may be giving away a large portion of the cash flow that might fund your retirement. Many businesses are worth more from a cash flow standpoint while you're alive and running the business versus selling it and getting a lump sum and capturing that, the income that could come from that raw dollar amount. Someone who has a $10 million business, maybe they're bringing in $1 million a year of income off of it. So if you sell that, you're definitely not going to capture that same cash flow. So it can be important there to consider that, long in advance. And a second thing, and this is be a common thing amongst all four of these boxes, is understanding that every successful business is built on good people. Meaning that, if your business is successful, it's largely probably because of the team you've assembled and the employees that have helped get you to that level of success. And they might be following you because you're the founder, you're the creator, or whatever your role may be. But if you gift it to another family member, that dynamic may change, meaning that, hey, the son of the owner isn't the same boss. I'm here because of dad. You founded the business, and I followed you, and it's time to retire. When he retires, right? And then suddenly these key people that have helped make this business successful, what happens if they go away at the same time as you're passing the business? Is this sort of stunting the potential future growth of the business? Now, the second box here, of course, is a gift at the time of your death. And this is more commonly known as just the estate plan, right? When you die, and Ian went into this last time with the will and trust and how important that is, and it really is important. It's saying, hey, I want to run this business as long as possible. And when I pass on, hey, we know who it's going to go to. And it can be very important to know that we just can't predict when we're going to die. And this is where it becomes even more important, right? Because, there's two sides to that. You got first, what happens if you die too soon? I'll give an example. This is a real example, actually, of a law firm I know of that. It was very successful. They had 3 locations. It was a sole owner, law firm. The owner died of a heart attack, like at a gas station, out of nowhere. Still running it, still building the business. And so what happened after that? Well, it got a little messy, right? Because one is by intestate laws, his wife owns the business now, sort of, right? Because it's a law firm. And if you're not a lawyer, you can't own a business. You can't run a law firm. So she was left scrambling to sort of plug someone else into this firm to keep it going until she could try to find someone else to purchase this business. I can think of, in the case of many people with their kids, if you were to pass early and it's going to pass into a trust, and because you've got kids, are 3 8-year-olds, for instance, able to run a business even if there's a trust involved? I can think of a particular horror story of mine from a colleague in the East Coast who ended up dying. I see Ian, and he ended up dying before he had to set up, and his business passed to his 12 minor children. That was a hot mess.
And Nick asked a very rhetorical question with a very real answer, and the answer is no. Do not leave administration of your company to your 8-year-old child. I have had clients who have tried to do things like this. I've had many clients of all stripes. Bad idea every time. So
yes. Yeah, and that's a quick way to have a quick end to a business, possibly, right? So now the other side of that coin is what happens if you live too long? Do you still want to be able to be running your company, or will you still be capable of running your company to the same level you are today in those last 3 decades of your life? Meaning when you're 70s or 80s or 90s, when you might want to step back. I dealt with this one a couple of years ago where someone owned a whole series of franchises, And they were great. Now, when they started getting to retirement age, they started going, well, we don't want to keep living like this. We want to be with our kids in Colorado. And we still got businesses throughout New Mexico. So they had to, originally their plan was, we're just going to keep running this thing forever. But their family dynamic changed. They had grandkids. They wanted to travel and do all these things. And so while it was critical they had that estate plan in place, they still also had to have that shorter term succession plan for while they're living. And for them, it involved some key employees taking over a percentage of ownership of the business so they could kind of sip coffee in Colorado and read P&L reports and still offer that guidance. Now, these bottom two boxes get really fun. A sale during your life is, of course, is a sale of your business. And for many businesses, this is the end goal. You start it up and you say, hey, I'm going to build this thing up. It's going to have value. And when I retire, someone's going to come at me with a briefcase full of cash and I'm going to go buy an island. That's the dream. Now there's a number of things to keep in mind about this. One, not all businesses have the same value at the time of sale. Professional businesses, for instance, CPAs, attorneys, financial professionals, amongst a few, right? For us, hey, when we hang up our coat for the last time, our suit in that closet on that last day, often the business ceases to exist. You were selling artwork off the walls. Now, if you're like a manufacturing company and you've got lots of assets, machinery and things, that can be a different story. And of course, there's the value that goes into the goodwill and the client base and all kinds of other things that as a business owner, you say, well, the business is worth all of this. Now, the number of business owners whose actual value of their company equals what they think it's worth that I've dealt with is, I could count in one hand and have fingers left over, right? As a business owner, we're always going to overvalue our own business. And there can be some interesting situations as well. I'll get into on this one, after I kind of discuss the methods of sale, right? Because that briefcase of cash doesn't often happen at all. Often as someone's trying to buy into a business, they're trying to do what you're doing with a business, which is trying to leverage money. They're trying to take some money and create more from it. So they're not going to go and pay off the business with a lump sum from their bank account. More often than not, they're going to go get a loan from a bank, or it's going to be funded on a note or some combination of the two. Now for a loan, from the bank's point of view, the bank's perspective, not all banks are going to look equally at a business succession loan. Some banks really like them. Some will only deal with certain types of business succession loans or certain types of businesses, and some won't even deal with them at all. From a bank point of view, it's a risk assessment, right? If we say, hey, Jim's been running this business, he founded it, he built it from scratch, and he made it successful, and he's leaving, right? And you want us to back a loan for you to take that over. Well, that might not be a risk that the bank might want to take. Not to mention, of course, the credit worthiness and so on. So the business owner will essentially act as a bank in many cases. And that's where we come in with a note. I just assisted in helping wrap one of these up recently. And that was exactly what happened. Was the key employee who wanted to buy the business could not raise the proper amount through a loan to buy the business. And so there's some negotiation and valuation. It was finally agreed upon by the various members involved that it would be a 5-year note. Now, the business owner was able to take on a higher interest rate because they're taking on more risk than a bank would. And so that's a bonus sort of to the business owner who's selling out. But they're also, that person's taking on the risk, because what happens if, for instance, same thing, those key people don't choose to go on with the new boss? What happens if they retire? And that's exactly what happened in this case. Is the key bookkeeper, the person who knew all the books, the numbers and everything and had for 20 years, said, hey, I'm going to retire at the same time. How does that impact the future of the business, right? What happens if the business makes it to year 2 and there's 5 years of payments? Or if there's something that you can't control, like a market shift. I can think of a printing company that was that I dealt with where that was one thing we had to look at, saying, well, they want to sell on a note, but is that industry in a downward slump? And it absolutely was true. And so that was part of the risk assessment. So that being said, though, it's a very, very common route to go, and it's great, especially if you're kind of taking a look at it maybe 3 to 5 years before you're trying to sell, making sure your business is in order, that you've got all the key pieces in place, and you can also avoid a lot of tax consequences with a proper plan that's started a few years in advance, especially with like capital gains rate going up potentially here in the future. Now, this final one, of course, is obviously in some of the title of this presentation. And this is a sale at the time of your death, which is known as a buy sell. And this can be used in a number of different ways. Now, it's my belief that just about any business should have a buy-sell agreement in place, even if you're a single owner business, as long as you've got a successful business. Now, I'll get into that more, but you see it most common with multiple owner businesses. And so let's say that myself and Ian both co-own a business. We don't, right? But let's say we were each 50-50 owners of the business. If I suddenly got hit by a bus and did not make it, then who owns that other half of the business? Well, it's not automatically Ian unless there is some sort of agreement in place for him to buy it. In fact, in that case, Ian would be in business with my wife, which he may or may not be interested in, and my wife may or may not be interested in, right? Because a business partnership is one of the most closest relationships outside of a marriage, right? You have to carefully choose who your partner is.
And fun fact, just to add a little wrinkle there, without a buy-sell agreement, maybe it's your wife, but before it's your wife, it's your estate. And your estate, being in business with an estate can be an unpleasant experience, especially if the estate has debts that it has to satisfy, because if it starts looking to the business, then all of a sudden, you could be in business with potential creditors, or you could be staring down a demand to have half the business liquidated or sold off to some third party to pay the debts of the estate. So the complications there can get really unpleasant really quickly if you don't have some plan in place.
Absolutely. And ultimately a buy-sell plan can touch all three of these other boxes too. Now, I mentioned there's 5 ways to exit a business, and obviously these are 4 of them, right? So the 5th one is, of course, liquidation, right? You're just fire selling the assets, right? If Ian and I are in business, I get hit by that bus, and then my estate is just, is a mess. Well, yeah, we're going to be possibly liquidating parts of the business to help pay for my mess. Or let's say it's not much of a mess, and my wife, who's probably wrecked, I hope she'd be wrecked from my death, that she would actually have an emotional reaction there. The first thing she's going to do, in my experience for my wife, is she's probably going to go to Ian and say, I want to be bought out of this thing. I don't want to run half this business. I don't know what's going on here. And so then Ian's going to be tasked with trying to figure out, okay, well, how does that work? Does the business have the cash available? What's going on? Can my wife pay the bills in the meantime? So there's a lot of complicating factors here. So, we're going to go through a few of these. So here's like a lot of the questions when it comes to business ownership or business succession that we get through. For your business, and as you're here listening, first see, all right, who do you see getting your business in the future? When do you see that happening? When you're alive? When you're dead? Are you just trying to create a business that really upsets a much bigger business that's going to buy you out? Great. Maybe that's your business model. Maybe it's something that you look at it and you go, I'm going to be working and waking up at 6:30 in the morning till I'm 150 years old. I don't know, running your business that way. But how do you want to exit this business? Like knowing that can help guide some of the earlier decisions in your business. Right? Who do you see as potential future owners of the business? Will it be a key employee or employees? Do you have other partners that could take over? Do you want to sell out to your business partner? Or do you want to go and, sell it to a competitor, something to that effect? What do you think is the value of your business as a going concern? um, that can be a tricky one to like check in and go like, what's my business worth now? Not a lot of people would know that right off the top of their head. Um, but often your accountant can kind of give you some clues into that, for your CPA. Um, what is the value of your assets if liquidated without succession, right? What happens if you don't have a seller and you just need to exit the business? Restaurants in particular are probably a type of business that has to deal with that a lot. Well, who wants to buy a business that's a family-run thing? You're selling just the equipment in the kitchen, which is probably used, heavily used in many cases. Um, if you have business partners, who gets the ownership at the first death? What happens if all the business partners die? And then finally, will any ownership change? Will any ownership change hands while you're living? So these are just good things for you to kind of do a self-check on. And these are the questions that we'd go through with clients anyways. All right, so before I move on to kind of buy-sell agreements, and I get excited talking about this stuff, let's check in. Are there any questions out there? Because I don't see any yet in the Q&A, but if you have any, feel free to pop some up now.
They can always raise their hand and we can allow them to talk. They can also hold them till the end if there's any questions coming in.
Perfect.
Yeah, doing great. I'm really interested in this topic. So
Yes. Well, let's dive into the buy-sell agreement itself. Okay. Buy-sell plan, buy-sell agreement. What is it exactly, right? And this is, Ian's probably got a slightly more legal definition of it, but essentially it's an agreement that can help meet two different types of at-death ownership transfer needs. It's a mouthful to say. Basically, hey, sometimes the owners want to wait and sell their business at death because they don't want to give up ownership while they're living. So they choose to maintain that ownership while they're alive. And then they have that buy-sell agreement in place that makes a nice, clean exit at the time of their death. Now, sometimes also, the owners desire to provide protection against premature, unexpected death, right? If that bus gets you, you want to make sure that you sell not only to protect the interests of your business partners, right? But especially making it nice and easy for your family to make sure that they're capturing the proper amount out of that business so that they can still maintain the same level of lifestyle, ideally. Now, sometimes a buy-sell agreement can cover a lifetime sale when you want to exit the business at retirement. We're going to dive into how that works. We might call this like a bonus buy-sell or something to that effect, where you'd use cash values of life insurance to help offset a sale. Or it can be done like note, bank financing, and so on.
I'm sorry, could I weigh in one thing there?
Absolutely.
I get a lot of requests for buy-sell agreements for partners who may want it to trigger for some reason other than their death. Let's say they want to walk away from the partnership, they want the partnership to be required to buy them out. As Nick's going to talk about, the funding mechanisms, a lot of them involve life insurance that's only payable on a partner's death. And so, in lieu of obligatory buy sell agreements in those situations, I usually steer people towards a right of first refusal, where if someone wants to have a third party buy them out, the company or the other owners have the right of first refusal to buy them out. If, say, they have the money or the interest, maybe sometimes you want to just let a third party buy in for more infusion of capital, or because you like them better than your old partner. But the buy sell agreements are great. Like Nick was saying, for planning on the event of your death, or sometimes if the company's going to have the money and you really just want to compel them to buy you out when you're ready to walk away.
Definitely. Now let's take a look real quick at a really simple case study, right? And these are sort of made up, but let's say we've got George and Tim that each own 50% of a manufacturing business. Doesn't matter really what type of business it is. Now, George is married with children. Tim is divorced with 3 minor children. Now, assuming there is no buy-sell agreements in place, what happens in this case if either of them were to die? Long story short, it's going to be a bit of a mess, right? If George were to pass, of course, as Ian mentioned, it's going to go to his estate. That 50% of the ownership goes into his estate first. And then If it resolves from there, then it might go on to his wife. And she's trying to support children. Like if you look at the actual real life implications of something like this, it depends on what she's doing. But for many business owners, the spouse might be the one who's uh, not the primary income earner or the main income earner. So the death of a business owner might really impact the lifestyle of their family. Um, Now, Tim might want to be in business with George's wife, who knows? But I don't see that often, right? Now, if Tim were to die and he's got 3 minor children, it goes into his estate, and that's just as equally a mess. Not only from Tim's estate point of view, but estate planning point of view, but from the business. And then also the reality is that George and Tim, if they went into business together, more likely than not, they each have unique abilities and they both cover very specific parts of that business in their skills and time. So if one of them were to pass, that's going to impact the business severely, most likely, in that who's going to do George's job if he died, right? Tim's taking care of that while dealing with all the other aspects of this. And then also probably trying to take care of George's family in the middle of it. And we're going to revisit that a little bit. So the basics of a buy-sell agreement are the actual, buy-sell agreement, which is a legal document or a legal agreement. This is the part that, like Ian does, the legal profession. And then the second part of it is, of course, the funding, right? Where does that funding source come from? And within that legal document, and this is really simplifying things, and I'm sure there's a lot more that Ian can touch on if need be here, but just to make it simple for everyone, like there's parties involved, there's a triggering event, and there's typically some agreed upon evaluation method. And the parties involved might be the owners if there's multiple owners, or it might involve, let's say, a key employee agreeing to buy in, and or something like that, or a key employee who just bought it, and there's a buy-sell agreement in place just in case they die. Or it could even involve outside parties, like a third-party company, saying that, hey, if my business that I run and I solely own, if I were to die, I might want that person who's my kind of cooperation, like a competition, this other company that I know and respect, to be able to pick up and run with it. A triggering event is death as a common one, but it could be other things as well, like Ian is touching on. It could be disability, right? What happens if George gets in that car, locks up the shop at the end of the night, gets in his car and goes to drive home and doesn't make it home, but doesn't die, but can't work anymore? Well, what happens then? It's still a loss of a business owner, but it didn't trigger the death thing. So you might want to have some disability clause in there. And an other fascinating scenario, I can think of one where the company had, I think, 3 business owners, and one of them did something that put him in jail, something very heinous, like very morally wrong. And he'll be in jail for a very long time. They didn't have an exit clause. 2 years later, he's still on the payroll, and it's bad optics for that company. And so they've been trying to untangle that. So sometimes you might even have the ability to put in more things in there. So Ian, I'm going to let you take this one. This is just my knowledge. This is my experience.
So 2 points of interest. When I draft an operating agreement for an LLC, I always have provisions in there having to do with convictions, not necessarily arrests. Some people prefer arrests, but definitely convictions for crimes of moral turpitude or crimes that result in incarceration, to trigger an automatic buyout. Typically for book value. I mean, you can penalize them in some ways in the scenario, but buyout for book value, which can often be lower than fair market value over a period of time. So the company has to pay over 5 years pursuant to a promissory note, but they're out as an owner immediately to avoid issues of optics, issues of legal exposure. Yeah, I've seen some fun ones there. One common or somewhat common other triggering event that I've dealt with, especially in the context of law firms, is retirement. As odd as that sounds, just if a partner reaches a designated age of retirement, for example, 70 or 75 or 65, if you want to go that way, the partner can elect to step back and the company would have to buy them out again over a period of time via promissory note, but because there's no life insurance that would kick in to fund it. But Yeah, I mean, that's one event that I somewhat commonly deal with.
Yeah, I think I've seen divorce in one or two of them as well. I've had that where there was
Yeah.
a there's an entire board, and husband and wife or partner had interests in this company, and they got divorced, and then the rest of that kind of company had they bought them both out, like right
Yeah.
there. So now the third piece, of course, is the valuation method. Third party valuation is possible. That can get costly, but it's definitely a thing. Depending on the size of the company, it might make the most sense. You've got, or you might agree upon an amount. That's a common one I see, where you might have the business owner saying, well, based on these things now, or our CPA says this based on this. Okay, we agree that this would be the amount now, and we're going to review this every year or every 3 years or something like that, because the value of a business can change. Or there may be some other agreed upon valuation method, like book value, or something to that effect. Um, Now the funding, right? Well, how do you fund this thing, right? So if I died, um, and Ian, was going to buy me out, where would that money come from? And there's four different areas where this typically comes from. One, which is the least amount of leverage, would just be a sinking fund, right? Not a lot of businesses carry that amount of cash sitting around. Uh, it's not necessarily prudent business uh, sense to do that, right? Because if you're a business owner, your money's making money. And having that cash sitting around just doing nothing, waiting for someone to die, right? You could probably think of 1,000 things to do that'll get 1,000% rate of return. But
There's I'm sorry to interrupt. There's one other complication with using cash that my clients run into, which is that when you're talking pass-through entities, especially partnerships, S corporations, the cash that's sitting in the company's bank account, often called retained earnings, in a sense already belongs to some degree to the deceased partner and the deceased partner's estate, because it's been allocated to them for tax purposes. They've been assessed, they've paid the taxes on that money. The company elected not to distribute it to the owners entirely for whatever reason. Maybe the company wanted to keep the cash to pay its expenses or reinvest or grow the company. But when you look at who's entitled to that cash ultimately, there are issues where you can't use all of the cash in the company's bank account to pay for a deceased owner's shares, because some chunk of that cash already belongs to them. So the sinking fund is actually less than a lot of business owners think it is, just because of that.
absolutely, yeah, yeah, and you deal with that in succession a lot too, where there might be cash in there they've already paid taxes on that they just never took distributions. So I'm trying to figure out the sale price of a business. They're like, well, we've got 200,000 in cash that the business owner should just take. That's not even involved in the price. But anyways, now the other ways to do it, of course, is a note, meaning that, hey, if this person dies, if I were to die, then our company would then pay out to my family over a number of years and agreed upon, pre agreed upon kind of terms. Um, the business could go out and get a loan, right? Same thing as you're trying to buy a business, like in that kind of 4-box quadrant. Things to think about for this are, hey, if you're creating an agreement, we're saying we're paying out on a note, and someone dies, in 10 years, is the business still in the same position that they can afford a note? Is their cash flow the same as when they put that agreement in place? Or would that just tank the business? For a loan, hey, would the business, who knows if a business is in the position to get a loan, or even the other owner to get a loan at that period of time? If a business owner died in the middle of COVID and the business just sucked up all of their credit worthiness just to try to stay afloat, what position would that business be in trying to get a loan to pay out a buy sell at that point? Not a great one, right? And so we get down to the fourth one, which is life insurance, which is often the most efficient way to do it, because I mean, you sink in a small amount of premiums, from the business typically, but it can be done, through individuals as well. And what that'll do is that'll pay out. It is basically when that, if I were to die, the money is created so that Ian can then buy out my half of the business in this theoretical situation. It can work really clean when done right. Now, so let's just take a look at the same case study, how it's different, right? without getting into too many of like the details of how it's structured, hey, George and Tim, same scenario, but this time they have a buy-sell plan in place funded by life insurance. George dies, that agreement's triggered, the money is created from the life insurance so that Tim can then pay out George's family or his estate and buy that half of the business. It's a clean exit and it's a win for George's family. And it's a win for Tim, who can then say, great, that's one less thing on my mind. I can go to figuring out how to run this business without George as much as possible. And same thing with Tim, right? George can then, money's created. George doesn't have to miss too much of a stride, much less than otherwise. So checking in again real quick before we really dive a little deeper into this. I don't see any questions yet, so we'll tackle them at the end there. So the life insurance piece, because it's so heavily involved in a buy-sell, let's dive into it, right? What is life insurance? Just to really get basic, it's a contract, right? At the time of the primary insured's death, the death benefit is paid tax-free to the beneficiaries. It's out of estate, it's out of probate, and it's just a direct payment. The individual has to go through underwriting. So there are indeed scenarios where if two business partners are trying to get life insurance, someone might not be insurable. So it's also critical to try to tackle this, when people are younger and healthier. It's always a benefit versus I dealt with a situation recently where two business owners, they were trying to redo their buy-sell policies, and one of them had a heart attack in the last year. And so they had to create an agreement for a note on that gap. Now there's two main types of life insurance. There's temporary, or term is also known as, and then there's permanent life insurance, of which whole life is the most common, but there's a lot of different types besides that. This is my grid that normally I doodle out, and I'm not confident enough in doodling with my hand on the whiteboard here. So just so everyone understands that, how this can work, because it can really affect the business, is term, typically you'd have a death benefit that would stay level. And then you'd have premiums that you pay that would last for that term of time. And then when that term ends, the premiums would jump up in price. And in life insurance in general, premiums are based on age, gender, and health, meaning that the younger you are, the healthier you are, and if you're female, it's cheaper. So it's the thing to know that, getting life insurance when you're 20, the same policy when you're 60, it's going to be much more expensive for that premium. Now, when a term comes into place for a buy-sell, one thing to really keep in mind is it's the most cost-effective way to get death benefit by far. But the cost, the value of a business changes over time. And for term life insurance, that term ends also. So that's something we'd always caution people to say, hey, if we want to create this buy-sell agreement funded by life insurance, how long do we want this funded? And do we see the growth trend for the business going up? How are we going to manage that gap if your business is worth twice as much as this policy in 10 years? Now, permanent life insurance is a little different. We'd have premiums that would be higher, but typically they'd stay the same. And often you can actually, make them shut off at a certain point. And then you've got a death benefit that'll rise over time. And then it has a third component called cash value, which will also grow over time, kind of builds equity inside these policies. For classic whole life, it's going to build up, not tied to the market. It's going to be guaranteed growth. Depending on whatever life insurance company you use, it may also have dividends on top of it. And just know that not all life insurance companies are created equal, right? I'm not going to go into the depths of it, but there's stock companies, there's mutual companies, and the permanent life insurance products from those can be vastly different as far as how the death benefit and cash value grow. So again, term life insurance, that same premium for the same number of years. It might be a 20-year term. And that can work out really well for a buy-sell in some cases, saying, hey, we just want to cover this for 20 years and we're good. Doesn't build any cash value. When that policy expires, the business isn't getting anything back, It's just covering a risk. And then, of course, permanent life insurance, I already kind of touched on all that. It actually does build the cash value, which means there's a chance the business could get some cash back if it's not needed down the line. Now, touching on that cash value in life insurance, within the policy, cash value in life insurance grows tax deferred and can be accessed tax-free in most cases, not all, but most. So that can really play in sometimes into those permanent buy-sell plans. And again, the life insurance company specific products can be very different company to company. And the roles in the business, and this is touching just on some terminology, where from the financial point of view, we'd actually classify each type of policy in a business in its own specific way, to the point where a life insurance application for business, they've got specific like check marks in there saying, hey, the purpose of this would be for a buy-sell agreement. Or the purpose might be a key person, right? Meaning like that would be something owned by the business and then would pay out to the business in the event of an owner or any other key person's death, just to help create some liquidity when that person dies, or if that person were to die, to recruit new talent or to cover those costs of replacing them in the meantime. And so many times you might see a buy-sell agreement funded and also some key person policies put in place. The most recent one I did, that was exactly what we did. Was one person was 90% owner and another person was coming in, had 10%, and they wanted that buy-sell agreement. So we funded both with term life insurance. But the younger person at 10%, they're going to have increased, they're absolutely key to this person's business. And the business would be sunk without him. And so they created an extra key person policy just in case he were to pass. Then that 90% owner could find someone else, or have the cash to at least give him some breathing room. And then finally, there's a third category called executive bonus. And this is more towards like key person retention. But it can really play into that succession process with sort of golden handcuffs agreements sort of thing, golden handcuffs contracts. So where you say like, hey, the owner is going to sell to this other person, but he wants those key people to stay on board. We might say, hey, let's put some policies or it could be something else in place on these employees, some financial instrument on these employees, and have a legal agreement saying, hey, if you work here for X number of years, then you get this free and clear at the end of that. But if you depart before that time frame is up, then you don't get that, or you get a reduced benefit or something to that effect. And that way, that can be a really good carrot and stick to keep key people on there, during that succession, or to help make sure that buyer is, giving them every chance of success, so they don't have just this huge brain drain from their company. So the buy-sell, specifically to fund a buy-sell agreement, it can be entity owned or cross purchase, meaning that, and there's a few other types, but these are the two most common. An entity owned would be where the business owns the policy and is the beneficiary of the policy, and the owners would be the insured. Especially when you get a whole bunch of business owners, this can be a very clean way to do it. There are some tax consequences to that. If life insurance is paying out to the business, it's tax-free to the business. But then as that goes on, to be paid out to an individual, there's tax consequences to that are different than if, for instance, you had two 50-50 business owners and they said, hey, we're going to just have these like owned by us as individuals on the other person. And they're just there in the legally binding contract. The buy-sell agreement is then the one that says, no, you have to do this with proceeds, so to speak. Now, the beneficiary, of course, depends on if it's entity owned or cross purchase, as I said. And again, the tax consequences of this are a little different, as well as tax consequences on the business, right? What the cost basis is, whether you're going to get a step up in basis as that other owner or not. Now, key person, business owned policy, where a key employee or owner is primary insured and the business is the beneficiary. And it's specifically to cover expenses in the event of the key person's death. And then finally, the executive bonus. It's an incentive, right? And again, it doesn't have to be life insurance, but that is a tool I've seen used a lot. And in these cases, the individual would typically own the policy and is the insured, and they would choose the beneficiaries, and there may or may not be a legal agreement around that. So let's take a look at like another kind of simple case study. Is we got George and Tim again. Now, this time they've got a third component here, is where Julia is the key employee of the company. She's the rainmaker, right? She's bringing over 50% of the sales, right? Now, George and Tim, they got that buy-sell agreement in place, but what happens if Julia gets hit by that bus that's out there somewhere, Well, that's going to be an impact financially to the company. So in cases like this, you might actually have a key person policy in place on her. What happens if she doesn't die, but the competition poaches her? Would that affect the business? Absolutely. And so that's where you might see more of that executive bonus or golden handcuffs sort of, agreement in place to say, hey, Julia, we want to make you unpoachable, right? So we're going to put some incentive in place for her. Because that's a common question I'm going to ask people and say, hey, if as business owners, all right, if your competition, like, you got this person you might be in competition with, in your industry. Now, what happens if you open up the news one day? I don't know if anyone looks at the paper. You're looking at the paper one day and you happen to see that they died. Your competition, the owner of that business died. You're going to send flowers and condolences to the family that you may have known. And at some point, though, you're going to put on your business owner hat and go, all right, who could I take from that company? How can I take over their segment of the market? And you got to understand that someone else is thinking that about your company if you got a successful company. So what are you doing to keep your people on board? Now, we get into another one, is like using a buy-sell as a pre-funded buyout or to offset a part of this. So in this case, George and Tim are still there, right? Now, George and Tim, they say they want to agree. They say, we're going to work in this business for about 15 to 20 years, then we want to sell. And they might have like a buy-sell agreement in place. So common question is, well, what happens if we don't die before retirement? What happens to that funding? Well, if it's funded by term life insurance, of course, you're not getting anything back. But you did that job of protecting your business between now and then. So now, what happens if it's funded by permanent life insurance? Well, this can be targeted, and we do a lot of these where you say, well, let's try to target what we think the business might get to in value at target date, and you can try to craft a policy within that would be much more heavily funded by the company, but could actually build up to a certain target of cash value at the time of retirement. So this reduces actually a lot of pressure on finding a buyer for your portion of the company sometimes. Or it might just be an easy way to get out, saying, hey, I'm going to take this cash value, I'm going to shift this policy into my personal assets, and that cash value can offset the amount that I'm owed by whoever's, by the company. There are tax consequences to that in certain situations, and that can change depending on your business entity. Right? If you're a C corp versus a partnership LLC, it's going to be very different, treated very differently on taxation. If you're an LLC and you've got policy in the company that has cash value, you can shift it into your personal assets without creating a taxable event. The same is not true of an S corp or a C corp. And so we've seen situations sometimes where companies might even try to compartmentalize certain things by saying, hey, let's create a separate LLC that just has the permanent buy-sell policies in there. And not only that, it's a little more highly protected because life insurance cash value in a business has a much lower level of protection against creditors and so on than an individual buy-sell, an individual life insurance policy might have. And I'm trying to get the last few minutes through here. I'll answer some questions, right? But finally, what if the value of their business increases over time, though, right? If they're funding it with term and they look 10 years down the line and they're trying to retire in year 20, well, what happens if their business is worth more? Well, they might have to get more life insurance. And that could be a problem if one of them or both of them are not insurable. So that's something else to consider, where sometimes permanent life insurance can be a good answer to that, because that'll increase over time in value as well. And a final one here, I think, is if you got a single owner, you can absolutely say, hey, I want like someone else to take over this business if I died, right? If Jim owns an IT company, if he dies without a plan, well, his wife or his family or someone might be depending on that income. So what if he's got, Laura, who owns another separate IT company, and they really respect each other in their businesses? You might say, hey, can we just write something up that says, if I die, you buy my business and clients and everything. We don't have to go through this whole thing of trying to acquire everybody. It just makes it really clean for the family, for the business, and the clients. So just know that's an option out there. And one last one here, and this is one we dealt with recently, of the business owner sold to their key employee on a 5-year note. Great deal for everyone involved. In this case, there's a buy-sell agreement as part of the sale in the terms, because if that new owner, that key employee who bought the business, died in year 2, gets hit by a bus or so on, well, where's the rest of that, the previous owner's income coming from? It's similar to a divorce. If 2 parties divorce, sometimes life insurance will be there to cover the amount of alimony they would have lost, the other party would have lost out on. And so in a business, it's very much the same, can be used in the same way. I think I've covered all of this stuff here. But yeah, I'm going to pause there and let's do some questions while we have time, because I could just gab on about this forever.
We do have a question.
Oh, I see.
Are you, yep.
Yeah, from Kathy. So Kathy, you own a small dog daycare, which was started in 2004, and you want to retire. And you have an employee who's interested in taking over the company. Good. So the process of selling him the company, and I know, from my perspective, and I'm sure Ian's got a lot more to flush out on this, would be you definitely want to, well, actually, you know what, Ian, why don't you take key on this one? Yeah.
So I talked about this a little bit in my last presentation. You can get very flexible with how your employee buys the company from you. One approach that I've taken a few times is to have the employee buy into the company, or maybe you gift them an interest in the company, some nominal amount, 5%, 10%, just to get them in the door. Once that's done, you have a structured buyout where the company can essentially buy your interest out and pay you over a period of time, with the company maybe signing a 5-year note. Maybe you have the employee personally guaranteeing the note, so that way if the company goes under in year 2, the employee is still on the hook for the remainder of the balance that's owed to you. So really it looks like a purchase agreement, a promissory note, maybe a personal guarantee, and maybe some instrument to have the employee granted their initial interests. I've done it that way a few times for tax reasons, to prevent the employee from having, for example, a large tax hit or personal liability sometimes. Another very common way is just to have a purchase agreement with the employee, where the employee is going to enter into a purchase agreement to buy out your interests. Same thing, they issue you a note directly, they're personally responsible for it. You keep a security interest in the company and its assets, and so you've got certain protections in place if, again, the employee defaults in year 2, for example, or maybe, as Nick said, they pass away in year 2. You want to have some protections in place to guarantee that you're getting paid, if not everything you're owed, then at least a substantial part of it.
I have a question for you, Nick. On slide 32, when you're funding for with maybe a life insurance,
Yes.
looking at that would be a long-term strategy, correct?
Trying to say, like, using that buy-sell plan, like funded by life insurance to help.
Right. I hadn't heard of that, and caught my attention.
Yeah, and typically we're looking, I would say if you're, more than 10 years out, that can be a possibility. When we start getting into the shorter time frames, you can sometimes offset some of it. And in some cases, it can work out really well if someone's in a high tax bracket in particular. In fact, I'm dealing with one now where we're trying to basically start utilizing that as a way to help shift assets, to protect, but also shift assets from the business into this policy. And then at the time of retirement, uh, the owner is able to take basically this giant, buffer asset into their personal assets. And, that thing's growing at about 5%, outside the tax system and not, part of market risk. So it's part of their retirement plan, and can work really well together with their investments. So, that's where we say, if we're creating a buy sell plan and they got some time, we say, well, we're looking really at kind of 4 different time frames, right? We're looking at between now and when you retire. What happens if something catastrophic happens? We want to protect against that. Second, what happens at the time of retirement? Can we use this to offset some of the buyout? Third, what happens between now and the end of life? All right, can that asset be then used to help beef up the retirement plan? I've seen some cases where life insurance policies are done in a way they're capturing a tax equivalent of almost 10% rate of return, and that's not every time, but it's possible. And then kind of the fourth time frame is what happens between now and retirement. You've got this kind of liquidity building within these policies. Sometimes you might not want to touch it, like it's emergency cash savings, but the reality is businesses are volatile. So if you have an extra kind of sinking fund within those policies, that can be a good thing if something like a global pandemic hits, and you need some cash real quick, depending on how the agreement's structured.
Thank you. Okay, we are running out of time. Does anyone have any last questions? We want to, you were chatted over some links. We are going to have this on demand, pre-recorded, and then after the first week, we are going to have it up on YouTube. So look for that. You'll get some follow-up emails with the links and some of our upcoming webinars for you. So if you need any additional information, you can always email me. I can send you to the right resources. And Ian, Nick, do you have any last words before we wrap up?
My last words would be proactive about this, because I've dealt with some very tragic scenarios where people were getting towards end of life for whatever reason. Maybe they discovered they had some terminal illness. Maybe they didn't expect it and it just happened to them, but they got started on this process way too late in the game and they just didn't finish in time. And all of a sudden, like Nick and I have said over the last 2 sessions, all of a sudden the estate is faced with, what do I do with this business? The surviving spouse is faced with, what do I do with this business? So be proactive. I don't think there's ever a point where it's too early to look at a comprehensive estate plan and a business succession plan. It's just one of those things that if you do it and you keep up with it and you keep it updated, it's going to yield dividends when the time comes and when you actually need it.
Absolutely agree on that. And I would say too, just because business and as business owners, your business and your personal everything collide constantly. So, you want to make sure you understand how the two work together, not only while you're living, but just in case something goes wrong.
Mm-hmm.
So, and absolutely back up what Ian said is the sooner rather than later, because the longer you wait, the less options you typically have.
I would also just like to add, just to throw it out there one last time, look at some of your resources available, especially for the small business community here in New Mexico. The SBDC offers free business counseling sessions, assistance with loan applications, and things that can generally help you get where you need to go, or at least, they can point you in the right direction. So it's a great resource that, given the price of free for a lot of it, I just recommend taking advantage of it and not, leaving an opportunity like that on the table, because, all of these different things that we've talked about fit together like pieces of a puzzle. You've got your estate plan, business succession plan, and just generally mapping out the future, how you're going to grow and manage the company. They all fit together in a certain way. So take advantage of the resources and be proactive.
And that is a great note to end on. Everyone is dismissed for today. Thank you, guys.
Thank you.